Imagine walking into a casino, right? You walk in, you sit down at the high-stakes blackjack table,
Okay, yeah, I'm with
and
you.
you just start winning. Like, a lot. I'm talking a 62% win rate on your hands.
Wow. Which, I mean, for a casino, that is an insane hit rate.
Right. And you aren't just getting lucky for an hour or so. You are consistently beating the dealer hand after hand for months.
You own the casino by midnight.
Exactly. You'd be flying home on a private jet. But here's the crazy part. In the financial markets, there was this massive, exhaustive study of 43 million actual trades.
That is a huge data set.
Massive. And it showed that retail traders hit that exact 62% win rate. They were actually guessing the direction of the market correctly more than 6 times out of 10.
So they were basically beating the dealer.
Yes. And yet the overwhelming majority of them lost every single penny in their accounts. So welcome to the deep dive. Today we are looking at a terrifying reality, which is why your own brain, like the very organ that kept your ancestors alive, is mathematically hardwired to sabotage you when there is money on the line.
What's fascinating here is that the people losing this money, they aren't foolish, and they aren't uneducated.
Right, we're talking about smart people.
Exactly. We are talking about doctors, engineers, lawyers, highly successful business owners. They are applying the exact same logic that made them incredibly wealthy and respected in the real world to an environment where that normal logic is just a fatal flaw.
It's wild. So today we are unpacking a really phenomenal, just deeply counterintuitive source text. It's a book titled Best Loser Wins by Tom Hougaard.
Such a great book.
It really is. And to grasp the gravity of what we're talking about today, I mean, we need to understand who this guy is, because he isn't some academic sitting in a university office running, theoretical models.
No, not at all.
He is a former JP Morgan analyst and broker who basically stepped out of the corporate banking world and straight into the incredibly ruthless eat-what-you-kill arena of high-stakes day trading.
And we really should quantify what high stakes means in his world, because the sheer scale of the risk, it fundamentally alters the psychological framework.
Definitely. Give us an idea of the scale.
So a typical retail trader sitting at home might risk, say, 5 or 10 pounds on a single point of movement in a stock index.
Right. Tom Hougaard is known to risk up to 3,500 pounds per point.
Oh my God, I can't even fathom that.
It's staggering. On heavily volatile market days, he has traded in excess of 250 million pounds in notional value.
Wait, 250 million in a single day?
In a single day. There are documented instances where he made over 17,000 pounds in under 7 seconds.
Okay.
And conversely, where he lost 29,000 pounds in 8 seconds.
Yeah.
So this is an individual operating at the absolute bleeding edge of financial pressure. Right, where the slightest hesitation or like an emotional misstep costs the equivalent of a luxury car.
Exactly.
Okay, let's unpack this, because the central premise of his entire philosophy is that 80 to 90% of retail traders hemorrhage their money.
Yep.
And brokers in Europe are actually legally required to post their failure rates right on their homepages. Depending on the platform, it's anywhere from 74 to 89%.
Which is just a financial slaughterhouse.
It really is. And Hougaard argues that the secret to being in that elite top 1%, the people who actually pull life-changing wealth out of the markets, has absolutely nothing to do with what the finance industry tells us it does.
Right. It's not about math.
Exactly. It's not about having a faster algorithm or better predictive math or subscribing to some crazy expensive chart software. It is entirely about mastering the psychological art of becoming what he calls an outstanding loser.
It is such a profound shift in perspective. To really understand why we have to become outstanding losers, we first have to examine the architecture of a quote-unquote normal winner.
Okay, what does that mean?
Well, Hougaard diagnoses the root cause of that 89% failure rate as something we can call the myth of the normal. His argument is pretty straightforward. If the vast majority of normal people fail spectacularly in the markets, then normal thinking is the enemy.
That makes a terrifying amount of sense.
Right. And the most pervasive, dangerous piece of normal thinking that every single human being carries into the market is the supermarket fallacy.
Okay, I love this concept. Let's break down the mechanics of a grocery run then, because it seems so innocuous,
Yeah, think about the neurological cascade that happens when you walk into your local supermarket.
Okay.
You need to buy household essentials. Let's say laundry detergent, coffee, and toilet paper. You walk down the aisle and you see that your regular brand of coffee, which normally costs $10, is suddenly marked down to $5. It's a 50% discount.
Right.
What is the immediate biological response occurring in your brain?
I mean, I get a rush. Honestly, I get a hit of dopamine. I feel like I've just outsmarted the system, or at least caught a really lucky break.
Exactly.
Because the utility of that coffee hasn't changed. It's going to taste exactly the same tomorrow morning. It has the exact same amount of caffeine, but I get to keep $5 in my pocket. It is an objective win.
Yes. That dopamine hit is your brain rewarding you for maximizing your resources. You are acting as a perfectly rational consumer. The utility of the item is static, and the cost has decreased. Therefore, the value proposition is heavily in your favor.
Right. It's basic survival economics.
But now, take that exact same neurological wiring, which has been reinforced over decades of living in a consumer society, and apply it to a financial asset.
Uh-oh.
You log into your brokerage account, you see a blue chip stock that was trading at $100 a share last month, and today it is trading at $50.
And my normal supermarket brain fires off the identical dopamine hit. It screams, look, it's on sale. It's a bargain. But I have to challenge this just a bit. If you look at the most successful investor in modern history, like Warren Buffett,
Sure.
the entire ethos of his strategy, value investing, is finding undervalued companies. It's buying a dollar for 50 cents. It's being greedy when others are fearful.
Right, the classic Buffett quote.
So how does Hougaard reconcile this idea that buying a bargain is lethal with the most famous wealth-building strategy on earth?
You are hitting on the exact point of confusion that traps millions of people. We have to separate institutional long-term value investing from retail trading.
Okay, how are they different?
When Warren Buffett buys an undervalued company, he isn't buying a flashing number on a screen. He is buying the actual cash flows, the manufacturing plants, the brand equity, and he intends to hold it for a decade or more.
Right, he's buying a physical business.
Furthermore, he has the capital to sit through massive drawdowns. He can afford to be early. A retail trader buying a leveraged derivative of a stock index because it looks cheap on a Tuesday morning does not have that luxury.
Oh, I see.
The utility of a stock in the short term is not static like coffee. A financial market is entirely driven by sentiment and momentum. If a stock has fallen 50% in a matter of weeks, it isn't on sale. It is exhibiting aggressive, fundamental weakness.
So the market isn't a supermarket aisle with fixed prices. It's an aggregation of the fear and greed of millions of human beings.
Exactly. The collective intelligence of the market has decided this asset is garbage. When you, as a normal consumer, step in to buy that falling market because you want a discount, you aren't finding a bargain.
You're just catching a falling knife.
You are stepping in front of a freight train of institutional selling. But the ego of the retail trader assumes they know better than the millions of other participants who are currently dumping the stock.
And the text has this incredibly vivid story that Hougaard tells about his time as a young analyst that illustrates this perfectly. It's the Marconi disaster.
Oh, this story is amazing. The setting is crucial to understanding the psychology here.
Yeah, lay it out for us.
So it is the early 2000s. Hougaard is working for a major financial firm, and his CEO invites him to attend Royal Ascot.
Which is, for context, a highly prestigious upper-crust British horse racing event. It is a world of top hats, tailored suits, champagne, and just extreme wealth.
Yes, and Hougaard is brought into a VIP executive coach filled with the firm's top-tier clients.
These are people who, by all societal metrics, have won at life. They are normal thinking taken to its most successful, wealthy extreme.
Exactly. And the CEO introduces Hougaard to the room and tells the clients, "This is our top analyst. Ask him anything."
No pressure.
Right. So one of the clients, a highly educated pharmacist, asks Hougaard for his opinion on a company called Marconi.
And Marconi was huge back then.
Massive. It was a telecommunications conglomerate, a total staple of the FTSE 100 index.
Yeah.
But it was in free fall.
Right.
Over the previous 12 months, its stock price had collapsed from 1,200 pence all the way down to 450 pence. The client looks at Hougaard and asks, "Do you think Marconi is cheap?"
You can almost feel the heavy expectation in that VIP coach. The client is looking for the professional to validate his supermarket dopamine hit.
He wants permission to buy the bargain.
He wants the expert to confirm that he has brilliantly spotted a clearance aisle discount in the financial markets.
But Hougaard doesn't play the corporate game. He looks at this room full of wealthy, powerful men and just drops a bomb.
I love this part.
He tells them, "Marconi is garbage, gentlemen. Why are you chasing stocks that have fallen in price? The stock market is not like a supermarket where it makes sense to buy toilet paper when there is a sale on.
Oh, man. He looks these VIPs in the eye and essentially tells them that their foundational concept of money, that Saturday grocery shopping mentality that they feel makes them savvy, will actually lead to their financial ruin.
And the fallout was brutal. He gets death glares from the CEO. The clients are highly offended.
Because they were already heavily invested in Marconi, right? Sitting on paper losses, just waiting for it to bounce back because it was mathematically so cheap.
Yes. But the punchline to this story is what actually happened to the stock. Marconi didn't bounce. It continued its death spiral, falling to 32 pence, and eventually the company collapsed entirely. It went to absolute zero.
Wow.
Those wealthy clients lost vast fortunes simply because they could not separate the utility of a household product from the momentum of a failing corporation.
It's a tragic demonstration of how intelligence in one domain just does not transfer to the markets. But the source material provides an even more fascinating case study.
It really does.
It shows that even if you do manage to break free of normal thinking and correctly identify a massive macroeconomic discrepancy, your brain will still find a way to destroy you if you lack the specific psychological framework of an elite loser.
Right, the story of the Paris hot dog and Black Wednesday.
I am obsessed with this anecdote. It sounds like something out of a movie.
To appreciate the brilliance of what happened, we need to quickly set the geopolitical stage. It is 1992. The United Kingdom is part of something called the European Exchange Rate Mechanism, or the ERM. The ERM was a precursor to the euro, and it basically mandated that European countries keep their currencies within a very tight artificial valuation band against each other.
But the underlying economies were totally out of sync.
Wildly out of sync. Inflation in the UK was high, while Germany was dealing with the costs of reunification. The exchange rates were a politically enforced fiction.
Which is the exact environment where George Soros famously realized the Bank of England couldn't mathematically sustain the charade, so he heavily shorted the British pound, literally broke the Bank of England, and walked away with $1 billion in profit in a single day.
Yes, and interestingly, Hougaard himself was a 22-year-old student at the time.
Oh, really?
Yeah, by sheer unadulterated luck, he happened to be walking into a bank to exchange his life savings from Danish krone into British pounds on that very day, and ended up with a life-changing financial windfall just because he was standing at the right teller at the right time in history.
That is incredible timing.
But Hougaard uses this era to highlight a completely different character, a man he simply calls the Englishman.
And this guy wasn't a hedge fund manager. He wasn't sitting in a skyscraper analyzing central bank interest rates.
Not at all. The Englishman owned a printing company in East London, but he happened to take a holiday to Paris. One afternoon, he walks up to a vendor near the Eiffel Tower to buy a hot dog.
Just a normal tourist thing.
Right. But the vendor charges him a price so astronomically high in French francs that the Englishman assumes he is being aggressively scammed because he's a tourist.
So he decides to investigate.
Exactly. He walks away from the tourist traps and finds a local Parisian supermarket. He pulls out a notepad and starts writing down the everyday prices of milk, bread, butter, basic household staples.
I love the ground level hustle here.
It's brilliant. He takes this list back across the channel to London, walks into his local grocer, and compares the prices side by side.
And through this incredibly simple observation, he realizes something profound that all the politicians are trying to hide. The French franc is massively, hopelessly overvalued compared to the British pound.
Yes, the ERM is forcing an artificial reality that is buckling under its own weight.
Yeah.
It has to break.
It is absolute genius. It's street-level macroeconomics.
So he calls up a brokerage firm, opens an account with 5,000 pounds of his own money, and just starts aggressively shorting the French franc. He relentlessly hammers this single high-conviction idea.
And when the currency markets finally snap and Black Wednesday hits, he turns that initial 5,000 pounds into 8 million pounds.
From a hot dog near the Eiffel Tower to 8 million pounds.
Unbelievable.
By all accounts, that should be the end of the story. He cracked the code, he beat the system, he should retire to a private island.
But the source text reveals that he didn't keep it. He lost it all.
He lost every single penny of that 8 million pounds and eventually went into debt.
How is that neurologically possible? I mean, how do you make 8 million pounds and not have the instinct to protect it?
Because making the money and keeping the money require two entirely different, deeply conflicting psychological skill sets.
Unpack that for me.
When you experience a massive, unprecedented financial win, your brain chemistry fundamentally alters. The sheer volume of dopamine and serotonin floods your system. And if left unchecked by extreme discipline, it causes profound ego inflation.
Like a god complex.
Exactly. Your perception of risk becomes permanently distorted. You begin to believe that the windfall wasn't a product of a unique historical circumstance, but proof of your own infallible genius.
You stop observing the market objectively as a chaotic system.
And you start demanding that the market bend to your will because you are the guy who turned $5,000 into $8 million. When your psychological framework remains normal, the market will always eventually reclaim its capital.
Wow. So if consumer logic, like the supermarket fallacy, is a death sentence, and if brilliant, out-of-the-box intuition like the hot dog guy is unsustainable without a psychological fortress, what do normal people turn to?
They turn to the illusion of control.
They look for a system that promises certainty in a chaotic environment. And that brings us to the massive multi-million-dollar cottage industry of technical analysis and chart reading.
Yes, we really have to critically examine the entire ecosystem of trading education. If you type "how to trade" into any search engine today, you will be inundated with weekend seminars, thousands of hours of video courses, and dense textbooks.
And they all promise to reveal the hidden secrets of the market.
They will teach you a highly complex vocabulary, things like Fibonacci retracements, Bollinger Bands, moving average convergence divergence, stochastic oscillators, Japanese candlesticks.
It's an entire lexicon meticulously designed to make you feel like you're executing high-level, rigorous science. I mean, it feels like engineering.
And that is the exact appeal. The human brain possesses a deep, evolutionary hatred for uncertainty. We despise chaos.
Right.
In our ancestral environment, chaos usually meant a high probability of death. When a retail trader looks at the raw, unfiltered price movement of a stock index, it appears as pure, terrifying, unpredictable chaos.
The brain literally cannot handle it.
No, it can't. So, we plaster our computer screens with these colorful mathematical indicators because we desperately crave a logical reason to enter a trade. We want an external authority, the chart, to dictate our actions.
Because that mitigates our fear of the unknown. And honestly, it absolves us of the responsibility if the trade fails. Like, I didn't mess up, the chart was just slightly off.
Exactly.
It really reminds me of the psychology behind reading a horoscope. You know, you read your astrology forecast in the morning paper, and it says something incredibly vague, like an unexpected conversation today will lead to a new opportunity.
Right. Highly ambiguous.
Later that day, you chat with a coworker by the coffee machine about a new project. Your brain instantly latches onto that interaction, confirms the horoscope, and you feel this deep, comforting sense that the universe has a predetermined plan and you are safe.
That is a perfect analogy.
Meanwhile, you completely ignore the 99 other things the horoscope predicted that were totally wrong.
That is a highly accurate psychological comparison. In the realm of cognitive science, this mechanism is called apophenia, or more broadly, patternicity.
Patternicity?
Yes. It is the fundamental human tendency to perceive meaningful patterns and causal connections in random, meaningless data.
But why did our brains evolve to do that? I mean, if it makes us lose money, why is it hardwired into us?
Because in an evolutionary context, false positives are much safer than false negatives.
Okay, give me an example of that.
Imagine our ancestors walking through the tall grass of the savannah. They hear a rustling sound. The brain has to make a split-second decision. Is it just the wind, or is it a predator?
Okay, I see where this is going.
If the brain incorrectly perceives a pattern, if it assumes a lion is there when it's only the wind, the cost is just a little wasted energy running away. That is a false positive.
Right, you survive to see another day.
Exactly. But if the brain fails to recognize a pattern, if it assumes it's the wind when it's actually a lion, the cost is death. That is a false negative.
Wow.
Therefore, our brains evolved as hyperactive pattern recognition machines. We are biologically incentivized to force a pattern onto random data, even when one does not exist, because historically it kept us alive.
That makes total sense. We see faces in the clouds or religious figures burnt into a piece of toast, and we see guaranteed profit in a random squiggly line on a financial chart.
Exactly.
And the source material just brutally dismantles some of the most sacred cows of the technical analysis industry using this concept. Let's look at the Fibonacci sequence, for example.
Oh, this is a big one.
This is treated as gospel in trading circles. It's supposed to be the golden ratio of the universe, like the mathematical fingerprint of God that dictates the spiral of galaxies, the shape of seashells, and supposedly the ebb and flow of the S&P 500.
The prevailing theory taught in nearly every technical analysis course is that financial markets will predictably retrace their movements according to specific Fibonacci percentages.
Primarily the 38.2% and 61.8% levels, right?
Yes. Traders worldwide will literally set their automated buy and sell orders at these exact arbitrary mathematical coordinates. They firmly believe they are tapping into a universal physical law that governs market behavior.
But Hougaard references a legendary clash of titans to prove that this is largely a collective hallucination. He discusses Larry Pesavento, who is deeply famous for trading these exact Fibonacci ratios, and Larry Williams.
Larry Williams is another absolute legend in the trading world, but heavily data-driven.
Right. And Williams decided to actually test the myth. He conducted a massive, exhaustive statistical analysis of the S&P 500 spanning a full decade.
10 years of data.
He pulled all the historical data and systematically looked at every major price retracement on an hourly chart for 10 years.
And the empirical data completely shattered the illusion.
What did he find?
The analysis revealed that the magical 61.8% Fibonacci ratio almost never accurately marked major market retracements.
Wait, really? Almost never.
Almost never. In fact, completely random, non-magical, mathematically insignificant numbers like 43% and 74% were far more common turning points in the S&P 500.
That is wild. So the entire foundational premise that the market implicitly obeys this cosmic mathematical sequence just failed utterly under rigorous statistical scrutiny.
Utterly failed.
So if a 10-year data study proves it's random, why do millions of people still use it? Why are there thousands of YouTube tutorials teaching people how to draw these lines?
Because of that evolutionary patternicity we just talked about.
Right.
Because it works just often enough to keep believers hooked. It functions exactly like the variable ratio schedule of reinforcement used in casino slot machines.
Oh, that makes sense. The intermittent rewards.
Exactly. When the market, through sheer random chance, happens to turn exactly at the 61.8% line, the trader's brain lights up with dopamine. It powerfully confirms their pre-existing bias, and the brain says, the magic works. I have control.
But what about the other 9 times out of 10 when it fails?
When the market blows right past that number 9 times out of 10, the brain easily dismisses it. It labels it as market manipulation, an anomaly, or just user error in drawing the chart. We only see what we have neurologically trained our eyes to see.
That confirmation bias is terrifyingly strong. And there's another story in the text that exposes the cynical side of this industry, and it's honestly borderline scandalous. It's regarding the popularization of Japanese candlestick charting in Western markets.
Yes, for context, Japanese candlesticks are a method of displaying price data visually. Instead of a simple line, they form thick and thin bars that show the open, close, high, and low of a time period.
And over centuries, traders have given specific visual formations these highly dramatic names.
Like the shooting star, the hanging man, the abandoned baby, the harami.
Retail traders will spend months memorizing encyclopedias of these visual patterns, believing they are secret keys to predicting future price movement.
But Hougaard describes having dinner with one of the most famous candlestick gurus in the world. The guy who essentially wrote the definitive books on the subject for Western audiences.
And Hougaard, being deeply cynical and analytical, points out to the guru over dinner that a vast majority of these patterns are essentially identical.
Yes. For instance, the price action that creates a harami and the price action that creates a harami cross are fundamentally the exact same market movement. They're just categorized with slightly different names.
So he, point blank, asks the guru if he's just inventing arbitrary variations of patterns to sell more books and expensive software alerts.
And astonishingly, the guru essentially admits it.
Wow.
He openly tells Hougaard that he doesn't even trade his own complex candlestick patterns.
Wait, the man who literally wrote the Bible on how to risk your life savings based on these visual shapes is not risking his own capital on them?
Nope. He recognized that there is far more guaranteed money in selling the illusion of certainty, selling the shovels during a gold rush, than actually mining for the gold.
That is just brutal. And the academic community backs this up, right?
Completely. The text references a comprehensive study published in the Journal of International and Interdisciplinary Business Research.
Okay, what did they do?
Academics analyzed over 6 decades of S&P 500 data, specifically to test the predictive power of these heralded candlestick patterns. The definitive conclusion was that they offer a little forecasting reliability.
Ouch.
Statistically speaking, the returns generated by trading these patterns were not significantly different from zero.
It's wild. It's like finding out the all-powerful wizard is just a guy behind a curtain pulling levers to keep you distracted. But Hougaard takes the argument even deeper to explain the actual biological mechanism of why we fall for the illusion so easily. And it involves how our visual cortex processes reality.
He uses optical illusions to prove how fundamentally untrustworthy our own sensory processing can be, even before conscious thought begins.
Yeah, he brings up the famous FedEx logo as a starting point.
Right, where there is a perfectly formed, distinct arrow hidden in the negative space between the capital E and the X. Once someone points it out to you, you can never unsee it. It dominates the logo.
But most people look at FedEx delivery trucks for decades and never notice it's there.
Exactly. But he uses a much more profound example, the MIT checkerboard illusion, created by vision scientist Professor Edward Adelson.
I've seen this one. It breaks my brain.
I want you to picture a standard black and white checkerboard. Sitting on this board is a green cylinder, and the cylinder is casting a dark shadow diagonally across several of the squares.
Okay, picturing it.
There is a dark square labeled A that is outside of the shadow in the light, and there's a light square labeled B that is inside the shadow.
And when you look at the image, your brain absolutely unequivocally screams at you that square A is dark gray and square B is light gray or white. It's not even up for debate. It is a visual fact to your conscious mind.
But here's the biological trick. If you isolate those two squares, if you use image editing software to remove the context of the surrounding board and the shadow, you discover that square A and square B share the exact same hex code.
They are the exact same shade of gray.
Yes, but even when you know this objective fact, when you look at the full unedited image again, your visual cortex refuses to let you see them as the same color.
Why is that? What is the brain doing there?
Your brain's visual processing algorithm is performing lateral inhibition. It knows that shadows make surfaces appear darker than they actually are. So without asking for your conscious permission, the visual cortex automatically color corrects square B.
It lightens it in your mind.
Exactly, to compensate for the shadow. The brain's algorithm overrides the raw optical data hitting your retina.
Here's where it gets really interesting. What does a checkerboard illusion about lateral inhibition have to do with losing your retirement account in the stock market?
It proves that our brains are actively manipulating and altering the raw data of reality before it ever reaches our conscious, logical decision-making centers.
Right.
If your brain will flawlessly lie to you about the literal color of a square on a piece of paper to fit its pre-programmed algorithms about light and shadow, what on earth do you think it's doing when you are staring at a flashing red and green stock chart?
Especially with thousands of dollars of your own money on the line and massive amounts of adrenaline and cortisol pumping through your veins.
Exactly, it's hallucinating.
It is forcefully color-correcting reality to protect your ego. It is seeing patterns that aren't there and aggressively ignoring danger signs that are glaringly obvious.
And that brings us to the absolute core of Hougaard's text.
The central beating heart of why 99% of traders fail.
It all boils down to cognitive dissonance, the paralyzing nature of fear, and the biological imperative to avoid pain.
To understand this, we must introduce the groundbreaking work of psychologist Leon Festinger.
Oh, this is the guy from the 1950s, right? Yes. In the 1950s, Festinger's actually infiltrated a doomsday cult to study what happens when people's deeply held beliefs are proven undeniably false by reality.
Talk about extreme field research.
Truly. Out of this research, he developed the theory of cognitive dissonance. This is the extreme mental discomfort, the visceral psychological stress, experienced by a human being who simultaneously holds two contradictory beliefs.
Or whose core belief directly clashes with new, undeniable physical evidence.
Exactly.
So in the context of our discussion, it's like deeply believing you are a highly intelligent, capable trader, while simultaneously staring at a computer screen that objectively states you are currently losing $5,000.
Yes. When faced with that profound dissonance, the human mind struggles to function. The stress is agonizing.
Because the brain's primary biological directive is to resolve that stress and return to equilibrium.
And tragically, it rarely does so by accepting the new evidence, admitting defeat, and changing its behavior. Instead, it resolves the pain by twisting logic, blatantly ignoring facts, or frantically searching for irrelevant information to justify and protect the original belief.
So how does cognitive dissonance explain the classic mathematical suicide of the rookie trader? You know, the oldest mistake in the book is cutting your winning trades incredibly short, but letting your losing trades run indefinitely?
Let's trace the actual neurobiology of a live trade to see this in action.
Okay.
You buy a stock, and immediately the price goes up. You are in profit. Logically, you would assume this feels wonderful.
I mean, yeah, I'm making money.
But for a normal person, being in profit instantly triggers immense psychological stress. You now possess something of value, which means you now have something to lose.
Oh, wow, yeah.
You become terrified that the chaotic market will turn around and snatch your paper profits away. Your brain is now holding two conflicting thoughts. I am winning, and I am in imminent danger of losing this win.
That tension is the cognitive dissonance.
Yes. To relieve that excruciating psychological pressure, you hit the sell button. You close the trade prematurely. You take a tiny fraction of a % profit just to buy back your emotional peace of mind.
It's like hitting the snooze button on a blaring alarm clock at 6 a.m.
That is exactly what it is.
You smack the button, and you get this immediate, beautiful, warm wave of temporary relief from the pain of waking up. But by seeking that short-term comfort, you are actually guaranteeing that you will oversleep, be late for work, and suffer a vastly more painful consequence later in the day.
That is a brilliant analogy.
You are actively trading your long-term success for a hit of short-term emotional comfort.
And the exact inverse mechanism destroys you when you are losing. You buy a stock, and it immediately drops. You are down $1,000.
Okay, now what?
If you hit the sell button right now, you crystallize the loss. You make the financial pain and the ego pain of being wrong, permanent, and real.
Right. But your brain's primary evolutionary objective is to protect you from pain.
So to avoid the acute pain of realizing the loss, you refuse to close the trade. You replace the objective reality of the loss with the subjective emotion of hope.
You just hope the market will turn around.
Yes. You hold on to the position as it drops $2,000, $3,000, $5,000, desperately enduring the bleeding because you cannot stomach the sharp, final pain of admitting defeat.
And this isn't just some fun psychological theory. The source text brings massive, undeniable empirical data to prove this is exactly how we behave.
The David Rodriguez study.
Yes. This absolutely blew my mind when I read it. Rodriguez was an analyst at a major foreign exchange broker, and he was trying to solve a mystery. Why were their retail clients failing so consistently?
So he pulled a data set.
A huge one. He pulled a data set of 25,000 individual retail traders over a continuous 15-month period.
And we must emphasize the scale of this data. They analyzed 43 million individual trades. This is a statistically flawless sample size of human behavior under pressure.
43 million trades. And what did they find? They found that these amateur retail traders actually had a win rate of 62%.
As we talked about at the very beginning of the deep dive.
Exactly. They were guessing the direction of the market correctly more than 6 times out of 10. That is a phenomenal hit rate.
But despite that incredible win rate, the vast majority of these accounts were slowly bleeding to death. They were losing all of their money.
And Rodriguez found the answer by looking at the spread between their wins and losses.
Right.
When these traders correctly predicted the market because they were so biologically terrified of losing their unrealized paper profits, they panicked and cashed out early. Their average winning trade made 43 pips.
A pip being the smallest unit of price movement in foreign exchange.
Right. But when they were wrong, because their cognitive dissonance prevented them from stomaching the pain of cutting the loss, they let the trades run wild. Their average losing trade was a staggering 78 pips.
Let that math sink in. They are winning 62% of the time, but when they win, they make 43 points, and when they lose 78 points.
Their losses are almost double the size of their wins. It's mathematical suicide.
And it is driven entirely by the biological desire to avoid emotional pain.
Hougaard gives a really poignant, real-time example of this with a friend of his to show what this looks like in the moment. They are both trading the DAX together.
The DAX is the benchmark German stock market index, known for being incredibly fast and highly volatile.
Right. So Hougaard and his friend enter a short position, meaning they are betting the German market is going to go down. And they nail it. They are dead right. The market starts tanking. They are making substantial money.
But as the profit grows, Hougaard notices his friend is in absolute psychological agony. He is sweating, tense, and he desperately wants to close the trade and take his profit immediately, even though the market is plummeting and showing absolutely zero signs of recovering or slowing down.
So Hougaard asks him why he wants to interrupt a perfectly good winning trade.
And the friend admits that the day prior, He had a terrible, undisciplined trading day. He lost 150 points.
Ouch.
He tells Hougaard that if he closes this current, highly profitable trade right now, the money will exactly offset the emotional pain of yesterday's failure.
He literally uses the phrase that he wants to get back to emotional equilibrium.
Yes, and Hougaard diagnoses the fatal flaw instantly. He tells his friend, "You aren't trading the DAX right now. You are trading yesterday's experience. You haven't wiped the slate clean."
You are trying to use today's market reality to heal yesterday's bruised ego.
It is a profound realization that most people live their entire lives without reaching. They are trading their mental well-being and their past traumas instead of reacting to the objective numbers on the screen.
So what does this all mean? If normal human biology, our evolutionary pattern recognition, and our profound fear of cognitive dissonance make us act this way.
If 99% of us are doomed by the very gray matter inside our skulls.
Right. How on earth do the 1% actually do it? What is the architecture of an elite trader's mind? They don't have a different species of brain, so what is their actual mental framework?
The transition from the 99% to the 1% requires a brutal, fundamental, philosophical shift. Top traders do not possess higher IQs than the doctors and engineers who fail.
They don't have magical charting software.
What they've cultivated is an exceptionally, almost abnormally high tolerance for psychological discomfort. They have managed to completely and utterly sever their ego from the outcome of any individual trade.
They don't trade to be right. They trade to make money. And Hougaard makes it clear that those are two vastly different objectives.
Precisely. I mean, you're touching on something fundamental. A normal person wants to be proven right because it strokes their ego and validates their intelligence. An elite trader expects immediate validation from the market movement itself. If they buy a stock and it immediately goes down, they don't argue with the screen. They don't pull out a Fibonacci chart to justify why the market is theoretically wrong, and they are theoretically right.
They accept that they are out of sync with reality. They exit the trade immediately to cut the loss, and they move on without a shred of remorse or ego depletion.
Exactly.
I hear that, but practically speaking, how do you do that? How do you just completely erase the memory of a terrible, painful loss you took just 5 minutes ago?
It's definitely not easy.
You can't just pull out a Men in Black neuralizer, flash your own brain, and forget the pain.
You do it by fundamentally altering your relationship with the mathematical concept of a win rate and leaning heavily into asymmetric risk. The source text shares a brilliant story about a man named Trevor Neal, who ran a hedge fund trading South African stocks.
Okay.
They were trading on a 1-minute chart, which is an incredibly fast, chaotic, noisy environment.
And their win rate was abysmal, right? I want to make sure I have the math right on this.
By conventional standards, it was atrocious. They won roughly 25% of their trades.
They were fundamentally wrong about the market's direction 75% of the time.
Yes.
Okay, stop there. If you are wrong 75% of the time in literally any other profession on earth, you are ruined. If you're a surgeon and you fail 75% of your operations, you go to prison.
Right.
If you are a lawyer and you lose 75% of your cases, you are disbarred. So how do you fail 75% of the time in finance and not go bankrupt? Walk me through the mechanics of that.
It entirely comes down to the mechanics of risk-to-reward ratios. This fund completely discarded the ego-driven need to be right most of the time. They accepted that being wrong is the baseline reality of the market. So they built a system around it.
How did the system work?
When they were wrong, which was 3 out of 4 times, they recognized it instantly and cut the loss immediately at exactly 1x their predetermined risk.
Let's say they risked $1,000. They lose, they are down $1,000.
Exactly. Yeah. But when they were right, that 1 time out of 4, they possessed the immense psychological stamina to sit in the acute discomfort of a winning trade, refusing to hit the snooze button, and they let it run. When they won, they made 25 times their initial risk.
Oh, wow. So they lose $1,000 3 times, meaning they are down $3,000. But on the 4th trade, they make $25,000.
Yes. They walk away with $22,000 in profit, despite being wrong almost all day long.
That is the mathematics of the 1%. They engineered a system where their ego is irrelevant and their asymmetric math was undeniable.
But executing that math requires an alien level of emotional detachment. Hougaard compares this detachment to elite athletes.
Specifically recalling a conversation he had at Wimbledon with the professional golfer Luke Donald, right?
Yes, where they were discussing Tiger Woods in his prime.
Golf is a great analogy because, like trading, it is almost entirely an isolating game played against the limitations of your own mind.
Exactly. Luke Donald told Hougaard that mechanically, purely technically speaking, Tiger Woods wasn't necessarily a vastly superior ball striker than the top 5 other guys on the PGA Tour. They all had perfect swings.
But Tiger's mental hard drive wiped itself clean faster than anyone else in history.
Yes. Donald admitted that if he and Tiger both missed a terrible, embarrassing putt on the 15th hole, Donald would carry the emotional baggage, the frustration, the cognitive dissonance of that failure all the way to the 16th tee.
It would tighten his grip, alter his posture, and poison his next swing.
But Tiger had this uncanny, almost sociopathic ability to just delete it. By the time Tiger walked to the next tee box, the missed putt literally did not exist in his mind anymore. He was entirely, wholly in the present moment.
That state of total presence is the ultimate goal of the elite trader. And this leads us to arguably the most powerful story in the entire text, the epiphany of Dr. David Paul.
This is a wild story.
It perfectly encapsulates this agonizing shift from ego to presence. Dr. Paul is a PhD mechanical engineer. He invented a highly complex mining drill, made a fortune, highly intelligent, highly analytical.
Naturally, he built his own automated, sophisticated stock selection software based on complex mathematics.
So this is a guy who is very used to being the smartest guy in the room, and he expects his intelligence to dictate reality.
Exactly. One day, his proprietary software signals a massive buy order. It tells him, based on historical data, that the market is about to violently explode upward.
So he calls his broker, places a huge, highly leveraged long position, and initially, it goes up.
He feels brilliant. His ego is validated. But shortly after, the momentum stalls, and it starts to drop.
And as a PhD engineer facing contradictory evidence, what does he do? Does he cut his loss?
Of course not. He cannot accept that his software is wrong, so he buys more. He averages down, committing more capital to a losing idea. But the market keeps falling, accelerating against him.
Now the cognitive dissonance turns into sheer terror.
Yes. He starts calling his broker, calling his trader friends, desperately looking for anyone to validate his original thesis. He starts pulling up Elliott wave counts, a highly subjective form of technical analysis, frantically searching for any obscure chart pattern that proves the market is temporarily wrong, and his genius software is right.
He is completely drowning in his own confirmation bias.
He is locked in a state of psychological paralysis with a massive bleeding position, and right at the peak of his panic, his wife walks into his home office to simply ask him what he wants for dinner.
Incredible timing.
She sees him sweating profusely, incredibly stressed out, staring wide-eyed at his multi-monitor setup. She asks if everything is okay. He points to the screens and starts frantically explaining that the software algorithm is never wrong, the Elliott wave count is positive, the macro environment is supportive, his friends agree with him, therefore the market has mathematically to go up.
And his wife, who we should note knows absolutely nothing about trading, algorithms, or complex charting, just looks at the flashing red screen, looks back at her panicked husband and says,
"It's going down, isn't it?"
It's just a brutal, icy dose of reality.
Dr. Paul actually tries to argue with her. He's saying, no, you don't understand the software. You don't understand the complex math. It's an ABCD formation. It's a temporary retracement. It's going to turn around.
And she just calmly replies, I don't know anything about that. All I see is that right now, right at this exact moment, the market is moving down.
And that simple observation is the thunderbolt. That is his moment of enlightenment.
Wow.
He realizes in that split second that he is not trading the market. He is trading his ego. He is trying to force a chaotic global financial system to validate his personal intelligence.
He realizes that the market is a raging river, and he is standing in the middle of it trying to command the water to flow backward based on a mathematical formula he wrote.
Yes, he immediately picks up the phone, closes his entire long position at a massive loss, and aggressively shorts the market. He aligns himself with reality and bets that it will keep going down. And he makes an absolute fortune.
Because he finally surrendered. He stopped predicting what should happen based on his ego and started reacting to what was happening in reality.
Exactly.
But this brings up a massive practical hurdle. If the David Rodriguez study proves that our baseline biology guarantees failure, it begs a massive question. How does a normal person actually train themselves to achieve that kind of Zen-like detachment?
You can't just wait for your spouse to walk in and drop a truth bomb on you every time you're stuck in a bad trade.
Exactly.
That is the critical pivot of Hougaard's entire methodology. If the goal is to stop being driven by the biological fear of pain, what are the practical daily steps to achieve that? Hougaard doesn't just offer platitudes like be fearless. He provides a rigorous methodology of psychological acclimatization.
Walk me through what that actually looks like in practice.
It's the exact same process used by elite military units to train for combat. Think about a Navy SEAL. The first time they are put into a live fire simulation, they are terrified. Their amygdala, the ancient fear thinner of the brain, is screaming at them to run away. It floods their body with cortisol.
So what does the military do?
They run them through the simulation again and again and again, hundreds of times. Through extreme, relentless repetition and exposure, the amygdala's response is forcefully dampened. The fear doesn't magically disappear, but it becomes habituated. It loses its paralyzing physiological power over the soldier's decision-making process.
And Hougaard actually forces himself through a version of this every single morning before the stock market opens.
Yes. While normal retail traders are looking at colorful charts, watching financial news, trying to pump themselves up and get hyped for the day with positive affirmations, Hougaard is doing the exact opposite.
What does he do?
He pulls up his trading diary and actively forces himself to review his worst trades. He makes himself look at his most painful, stupid, emotionally driven mistakes.
It is a deliberate, calculated induction of psychological pain. He is purposely triggering his own fear and ego bruising in a controlled environment before the chaos of the live market begins.
He is habituating himself to the reality of loss, so that when a loss inevitably occurs later that day, it doesn't shock his neurological system. It's expected. It's already been processed.
So what does this all mean? It sounds like the ultimate goal isn't to become some emotionless, fearless sociopath. The goal is to make your fear so incredibly familiar that it just becomes boring.
That is a great way to put it.
It makes me think of a horror movie jump scare. The first time you watch a scary movie and the monster jumps out of the closet, you spill your popcorn, your heart rate spikes, you are terrified. But if you watch that exact same movie 50 times, by the 50th viewing, you're checking your watch or eating a sandwich while the monster jumps out.
Exactly. The external stimulus is exactly the same, but your neurological response has been completely neutralized through exposure.
And Hougaard draws on the story of Philippe Petit to illustrate this process of neutralizing a terrifying stimulus.
Yes, Petit is the legendary French high-wire artist who famously strung a steel cable between the Twin Towers in New York in 1974.
And walked across it a quarter of a mile in the sky, completely without a safety net or a harness.
When you hear that, you assume the man simply possesses no biological fear of heights or death. He must be wired differently.
But Petit had a paralyzing fear of something else: spiders. Severe arachnophobia.
And when he was asked by an interviewer how he would deal with this fear if he had to, he didn't say he would use sheer willpower or bravery or positive thinking. He said he would use extreme immersion.
He said he would over-research the monster. He would read dense entomology textbooks, watch nature documentaries, visit zoos, and interview expert spider handlers. He would analyze their mating habits, their biology, how their mandibles work, how they weave their webs.
He would relentlessly force his brain to view the monster in the closet as a mundane, predictable biological mechanism. By shining an incredibly bright, clinical, analytical light on the thing that terrified him, he would systematically strip it of its emotional power.
Precisely. You disarm the fear by making it a subject of study rather than a subject of terror. And Hougaard applies this exact framework to another modern visionary who operates under extreme risk: Elon Musk.
Yes. When Musk started SpaceX, the idea of a private company building reusable orbital rockets was considered financially suicidal. The established aerospace industry openly laughed at him.
Musk himself mathematically calculated that the probability of catastrophic failure and losing his entire fortune was around 90%.
I've always wondered about that. How do you physically sleep at night with those odds? How do you make rational, multi-million-dollar engineering decisions every morning when there is a 90% mathematical probability that you're going to lose everything and be a public failure.
Musk utilized a psychological technique rooted in ancient Stoicism, which he refers to as fatalism. He actively, deeply accepted the absolute worst-case scenario before he even began the venture.
He mentally wrote off the money.
He accepted the failure and the public humiliation as a highly probable reality. By vividly visualizing and accepting the worst possible outcome in advance, the paralyzing fear of the unknown was removed. The threat was quantified.
And once the threat is quantified and accepted, the fear loses its power over your daily granular decisions. You are no longer acting out of a desperate need to avoid pain. You can act with absolute clarity.
It is the ultimate form of surrender. You surrender the need to control the outcome. Which brings us to the final metaphor in the text, and I think it's the most beautiful and applicable one for anyone listening, even if they never touch a stock chart: the surfer analogy.
It is a profound way to conceptualize our relationship with any massive, uncontrollable force, whether it is the global financial market, the macroeconomic cycle, or the chaotic nature of life itself.
A surfer does not walk into the ocean and try to dictate where the waves will break.
They do not get angry or suffer cognitive dissonance when the ocean is flat. They do not pull out a mathematical Fibonacci chart to demand that a 6-foot wave appear precisely at 10:04 a.m.
Because that would be insane. You cannot control the ocean. The ocean doesn't care about your ego. Trying to force a wave where there isn't one is exhausting, and fighting a wave that is too big and closing out is incredibly dangerous.
So what does the expert surfer actually do? They paddle out past the impact zone. They sit quietly on their board. They observe the horizon with absolute objectivity.
They feel the energy flow of the water beneath them. They are infinitely patient, conserving their energy.
And when the right energy presents itself, they don't fight it. They align themselves with it, They paddle into it and surrender to its momentum. If the wave suddenly closes out or loses power, they simply kick out, accept it, and wait for the next one. They never blame the ocean for a bad ride.
Wow. Okay. We have covered an immense amount of ground today. We started out thinking we were going to be doing a deep dive into finance, into charts and algorithms and high-stakes day trading. But this has actually been a rigorous journey into human evolutionary neurology.
It really has.
To win in an incredibly hostile zero-sum environment, Hougaard fundamentally proves that you have to stop acting normal. You have to stop shopping for dopamine-hit bargains in environments that demand momentum.
You have to stop trusting complex charts that are essentially just mirrors reflecting your own desperate need for certainty in a chaotic world.
And most importantly, you have to realize that your brain's biological mandate to protect you from temporary emotional pain is the exact mechanism that guarantees your long-term destruction.
It is a masterclass in behavioral psychology and self-awareness. And it is crucial to remember that this framework goes far beyond the trading floor.
Clinging to a bad situation, whether it is a failing financial investment, a toxic romantic relationship, or a dead-end career, simply to avoid the temporary sharp pain of admitting you were wrong, is a universal human trap.
We hit the psychological snooze button on our lives every single day because waking up to reality hurts. But the compounded cost of that delayed awakening is astronomical.
Which leaves us with one final, deeply provocative thought to chew on. The source text definitively proves that in the financial markets, acting like a normal person is a mathematical guarantee of absolute failure.
It really is.
It forces you to turn that analytical lens back onto yourself. Look at the murky landscape of your own daily decisions and ask, in what other areas of your life are you doing exactly what everyone else does, simply because it feels biologically comfortable? And by avoiding that temporary ego-bruising discomfort, what spectacular, life-changing victories are you permanently locking yourself out of?